How I Make $50,000 a Year Without a Job by Mark Yegge, Passive Income, Covered Calls, and Stocks. My opinion is that Mark makes almost all his money by selling courses, which is fine. If you own and operate a hedge fund, then a lot of your time is going to be spent looking for assets and trying to increase the assets under management. That way you can charge the management fee. I'm not against selling services or selling products. The thing that bothers me is when you're selling products that don't actually add value. And his overall strategy, selling covered calls, in my opinion, is horrible. It underperforms the market. And I know a lot of people say that they don't really care about that because they're primarily looking for income. But if you're looking for quote unquote income, then you're much better off simply holding on to the underlying stock, not doing anything. And then when you need some type of distribution or quote unquote income, then you can just simply sell a few shares. But let's go through this video and see what Mark says.
It's Mark here from the Cash Flow Machine. Let me ask you, are you tired of living paycheck to paycheck?
Yeah,
are you tired
I'm
of
tired.
the stress that comes from every time the rent is due or your car needs repairs?
Right here, what he's doing is he's building up a pain point, and then he's going to present himself as offering a solution.
If eggs jumps again, are you tired of that? If you've ever dreamed of generating,
All right, let's see what his solutions are.
but it requires capital, it requires management, and it requires a tolerance for tenant drama, right? That 2 o'clock in the morning plunger that somebody's toilet plugged up, it requires that. So
I guess his first recommendation is real estate. And then it looks like he made up some random numbers here. Let's see what the numbers are.
a month in gross rent. Now let's subtract. Mortgage, $1,100, let's say. Taxes and insurance, $250. Maintenance and vacancy, another $250. And that leaves you with about $800 a month in net cash flow.
Let's see what his second recommendation is. Dividends.
Dividends are your friend. Dividend stocks and ETFs, which are exchange traded funds, they pay you just for owning the shares. So let's say you build a $200,000 portfolio of dividend stocks with an average yield of, say, 3.5%. That gives you $7,000 a year in income, or $583 per month. Now, let's get creative. If you invest in monthly
The problem with dividends is that they're taxed at a higher marginal rate than long-term capital gains. And one thing that's very important to consider when you're allocating your capital, you should look at it as a vote of confidence. You're investing in the management of that company to grow your money better than you feel that you can grow it. Why would you want that company to pay you money back as opposed to investing in its own business? If it's paying money back to its shareholders, then the company believes that the greatest use of capital is in the form of a dividend as opposed to investing in capital expenditures to grow the company in the future.
dividend payers like realty income.
Let's see what the next one is.
All right, the next strategy is skill-based income. You might not think of yourself as a consultant, but if you have any expertise, marketing, writing, technology, business, health, you can likely monetize it. Let's say you're a marketing pro and offer one.
Okay, that's fine. And then covered calls.
It's covered call investing. I'm going to show you how it works. You buy 100 shares of a stock and you sell a call option against it. That call option is basically someone paying you for the right to buy your shares.
The problem with that is by selling a call option, you're giving up the upside potential of that stock in exchange for a small amount of money right now. And you're virtually guaranteed to underperform simply buying and holding. And I know, like I said earlier, that a lot of people, they say that they don't care, that they want the income. The counter to that is you're going to make more money by simply buying and holding the shares and then selling a few shares if you need the money
At a specific price. And whether they exercise the option or not, you keep the premium. I call that the juice. The juice is the time premium.
The other problem when you sell covered calls is that during a bear market, you're basically going to get crushed because you're only holding on to downside risk and you've capped the upside potential by selling calls. And because crashes tend to happen pretty quickly and pretty violently, I've seen situations where people want to liquidate the shares, but they're concerned about selling the underlying shares because they don't want to have naked calls outstanding. Meaning that let's say the market tomorrow is going to fall 5%, and then people feel that the market's going to continue to crash. If you're long shares and you also have short covered calls, You might be hesitant to sell those shares because you don't want to have a naked short call outstanding. I've seen that happen numerous times. I think that overall selling covered calls is a really bad strategy. But let's see what else Mark says.
Not the whole premium, but the time premium. So let me show you a real world example using a stock that's been on fire over the last couple of years, and that's Nvidia. Now, Nvidia is currently trading around $110 a share, and 100 shares is $11,000. So let's say that you sell a monthly call and you collect $4.50 per share in premium, in juice. That's $450.
Mark's just using random numbers. Oh, let's say you collect $4.50. Okay, what specific delta are you selling in order to achieve that $4.50?
Per month, okay? Or $5,400 a year, just from that one position. Now imagine doing that with 3 similar stocks like AMD, Microsoft, or Apple, or Tesla, or Netflix. $11,000 times 3.
Right, but what he's not telling you is that if those shares spike up, then you're going to miss out on the upside potential.
Positions is $33,000. That's 450 times 3 is $1,350 a month. That's $16,200 a year.
Right, great. So now he's telling you all the positives of covered call investing. Here's a prompt that I put into Gemini. Does selling covered calls on stocks outperform the market, or is it better to simply hold the stock? Simply holding the stock generally outperforms a covered call strategy over the long term, especially in a bull market. While covered calls can provide a consistent income stream and some limited downside protection, this comes at the cost of capping your potential for significant gains. Studies and analysis of covered call indices such as the CBOE, S&P 500 Buy Right Index, BXM, show that they generally underperform the total return of the S&P 500 index over the long term. While the covered call strategy can outperform in periods of low volatility during a bear market, the limited upside significantly hinders its performance during strong bull runs. So there you have it. I definitely wouldn't recommend selling covered calls. If you have any questions, then let me know. If you disagree with this video, then let me know as well and leave your comments below. And then briefly, I drilled down on the actual returns of BXM versus SPY, and you can see that the difference in returns are actually quite substantial. For a 10-year period ending in mid-2025, the S&P returned about 13 to 16% a year, and BXM, which is a covered call ETF, only returned about 7 to 10% a year. So you're looking at about a 6% decrease in returns just because of a desire to generate what you perceive to be monthly income, but it's costing you money, about 6% a year, and probably more because you're paying higher taxes on the covered call income as opposed to buying and holding.